Financial. This is the forge where we hammer out the truth behind all the market noise. Today, we are putting American Express squarely under the microscope. Their Q4 earnings report is just around the corner, and for 175 years, AXP has stood like a titan of finance. It's a symbol of premium service, of unshakable stability.
Okay, but let's be totally honest here. In today's market, legacy can be a four-letter word. So we really have to ask the hard question, is that 175-year history a foundation of solid steel, or is it actually a relic from a bygone era? Is it an anchor weighing them down? We're here to forge an answer.
That's it, exactly. Look, the street is expecting big things from AXP. There's really no question about it. And when you look at it, on the surface, the numbers look incredibly strong. And believe me, we are going to drill into those.
Right, but this is a company that has weathered civil wars, world wars, and dozens of financial crises. That kind of history, it leaves scars, and it builds certain habits, and not all of them are good. So, it's just not enough to look at the numbers. We have to stress test the entire structure. The business model, the history, the brand itself. We're going to dig deep, way past the headlines, and figure out if this is a genuine opportunity or if it's just a well-disguised trap waiting to spring.
Okay, let's dive right into this. On January 30th, American Express reports its fourth quarter results for 2025. And when you look at the consensus estimates, the market is painting a picture of an absolute financial fortress. I mean, they're predicting growth in almost every single key metric. It's a whole wall of positive expectations.
And our job today is to act as the inspectors on that wall. We need to check every single brick, test the mortar, and look for any hairline fractures before we'd recommend anyone take shelter behind it.
Precisely. The bull case is crystal clear and it is compelling.
Well, hold on a second. Before we get carried away by all the hype, let's just remember that high expectations can lead to a long, pretty painful fall. It's really easy to get caught up in the momentum, especially with a blue-chip name like Amex. But I want to know if this optimism is truly justified by the underlying strength of the business, or if we're looking at an investor trap that's being set right before earnings day. Is this fortress real, or is it just a facade?
All right, let's get straight to the raw materials here. To really understand why the market is so bullish, we have to look at the numbers they're pricing in. The consensus estimates, compiled by firms like Zacks, they show strength right across the board. This isn't speculation we're talking about. This is the fundamental data that forms the foundation of all the current sentiment. We're going to break it down piece by piece. First up, the bottom line. This is where the heavy lifting happens. The Zacks consensus estimate for quarterly earnings, it's pinned at $3.55 per share. Now, that projects a nearly 17% year-over-year increase. In this kind of economic environment, that is a staggering display of raw power. It suggests powerful profitability and incredibly efficient operations.
Okay, 17% is a huge number, I'll give you that. But profitability can be engineered. Are they just cutting costs to the bone? Or is there real, sustainable growth that's fueling this thing?
An excellent question. And the top line gives us the answer. They're not just getting there by slashing expenses. The consensus for quarterly revenues is $18.82 billion. That's a 9.6% year-over-year growth projection. So what this tells us is the core business is expanding. More money is flowing through their closed-loop system. When you see strong top-line growth and even stronger bottom-line growth, that is the classic, undeniable recipe for a powerful earnings report. So where is that revenue coming from? Well, it's being forged on the back of rising network volumes. We're looking at a projection of an 8.3% year-over-year increase from a base that was already a staggering $464 billion.
And what this number really tells us is that their core customer, the premium spender, is not pulling back. In a world that's worried about recession and inflation, the Amex cardholder is in fact spending more. This right here is the engine room of the entire operation.
Correct. And right now that engine is firing on all cylinders. This slide really lays out the architecture of the bull case. Let's break down the key pillars of this growth. First, just look at discount revenues, up over 7%. That is their core income from merchant fees. It's strong.
And then you've got average card member loans, projected to be up 8%. This means their members aren't just spending, they're borrowing. They're becoming more deeply engaged with Amex as a financial partner, which is really sticky.
And the network itself is still expanding. A nearly 5% increase in total cards in force shows they are still acquiring new members. But the real kicker here is that last line, net interest income, expected to surge by almost 12%. Every single pillar here looks solid, reinforced, and built for growth. This is the financial fortress the market is betting on. Okay, hold on. Let's not get ahead of ourselves here. The numbers look good on paper, I'll grant you that. But a fortress is only as strong as the ground it's built on. And history tells us that American Express is built on a foundation that has some deep, recurring fault lines, ones that the market seems to be conveniently ignoring right now. And these aren't minor issues, they're fundamental to the business model itself.
And look, this isn't ancient history we're digging up. Just look at this timeline. In 1991, you have the Boston Fee Party, a nationwide merchant revolt over their crazy high fees. Then, fast forward to 2016, they lose the Costco partnership. I mean, a catastrophic blow that just vaporized 8% of their entire billed business overnight.
A major blow, for sure, but one they ultimately recovered from and arguably became stronger for by diversifying their partnerships.
Maybe, but the pattern continues. In 2018, they're fighting an antitrust battle all the way to the Supreme Court over those same merchant rules. And just last year, a $15 million settlement with regulators over their sales tactics. This is a consistent, decades-long pattern of friction. These aren't just cracks, these are structural weaknesses in the foundation.
And this quote from their history, it perfectly illustrates the core problem that has never ever gone away. The very thing that makes them so profitable, those high merchant fees that drive the discount revenue you were just praising, is also their biggest vulnerability. It creates this constant simmering tension with the merchants who are the other essential side of their network. The bulls will always say this time is different, but looking at this history, I just have to ask, is it? Or is this a risk that's just waiting to flare up all over again? And this isn't just some ghost story from the past. We can see a crack appearing right now in the very same earnings estimates you're celebrating. Look at this. The Zacks consensus estimate for pre-tax income from their commercial services division, it indicates a decline of nearly 7% year over year.
That's a valid point. While the consumer side is clearly robust, the commercial side, which deals with small and large businesses, is definitely showing signs of pressure.
It's more than a sign, it's a warning light. It tells me the pressures from their business model are current, they are real, and they are impacting the bottom line today. You're right to point out the risks. They are absolutely real, and any serious investor has to factor them in. But you're missing the crucial point about why Amex can charge those fees, why they can weather these storms, and why that commercial segment weakness might not derail the entire enterprise. Their entire business is built differently from the ground up. They are not playing the same game as Visa or MasterCard, and that right there is their greatest strength. This slide perfectly illustrates the fundamental difference in their business models. See, Visa and MasterCard, they operate an open-loop system. They're just a network, like a public highway that banks like Chase or Citibank use to issue cards. They make fractions of a penny on billions of transactions.
So their game's all about volume and being everywhere?
Exactly. American Express is a closed-loop system. They are the bank, the network, and the payment processor all rolled into one. They control the entire experience. They're not building a public highway for everyone. They are building a private, high-end toll road. They're building a fortress for a select, premium clientele who are willing to pay for the privilege, and for merchants who want access to that clientele's massive spending power.
So the crucial point is this. Their foundation isn't just any customer. It's a high-spending, resilient customer who is far less sensitive to economic downturns. I mean, look at the data. The average Amex card member spends over $24,000 a year on their card. That's why their network volumes are projected to grow even in a tough environment. Their business isn't built on the number of transactions, but on the value of those transactions.
Right, so the brand loyalty built on perks, service, and those coveted airport lounges, it creates a deep moat. But is that moat deep enough to fend off the constant attacks from fintechs and lower-cost alternatives? That's the real test.
Okay, so we've laid it all out. On one hand, you've got the bull case, built on a structure of strong forward-looking numbers and a premium, resilient customer base.
And on the other, you have the bear case, built on a foundation with historical scars, the structural risk from their high fee model, and that current weakness we're seeing in their commercial segment.
So where does that leave us as we head into this earnings report? Is it an opportunity or is it a trap? So how do we forge our verdict from these competing arguments? Let's break it down into 3 steps. First, we have to acknowledge the risks you've outlined. They are real and they cannot be dismissed. The merchant tension is a permanent feature of their business model. It's not a bug. The Costco loss proves this risk has teeth.
Okay, then step 2, we have to weigh the strengths. The data shows their core business model is performing exactly as designed right now. The premium customer is spending, they're borrowing, and they're growing the network, which provides these impressive margins that Visa and MasterCard can only dream of.
So, our verdict is this. Based on the forward-looking consensus data, the financials suggest an opportunity. The growth is solid, the model is working, and the premium segment is proving its resilience. It's a heavily fortified structure.
Market skeptic. But, and this is a critical but, it's an opportunity with a permanent, built-in risk. That fortress is built on a known fault line. Investors need to understand that the merchant and regulatory headwinds will never truly disappear. They are part of the price of admission for Amex's high margins. This isn't a sure thing, it's a calculated risk. You're betting that the fortress walls are strong enough to withstand the inevitable tremors from that fault line.
Ultimately, this is the multi-billion-dollar question that investors need to answer. Is Amex's legacy a solid foundation for future growth, or is it an anchor holding them back in a rapidly changing financial landscape that's filled with nimble competitors? Market skeptic? The Q4 numbers will give us our next major clue. Lead analyst? Thanks for joining us on Iron Financial.